All right, this is being recorded. One thing I mentioned at the beginning of every one of my webinars is watch this again relatively soon after, especially if you're newer to options and if you're newer to my trading, because, or the way that I teach, I should say, my rules, because you can go out online and figure it out. I'm not going to tell you you can't, because it's out there, but they aren't going to tell you specific rules in and around when you should be implementing these specific option strategies. And there are a time and a place. There is a time and a place for each strategy. For instance, with this, we are in the medium volatility strategies, right? The synthetic short stock or the synthetic long, either one, can be built in any environment, whether it's really low implied volatility or really high implied volatility, okay? We've set this up as the medium volatility strategy because there are better, higher probability strategies out there for really high implied volatility and really low implied volatility that I would rather default to in those types of environments. This one, when it's right around the medium volatility, it's like we don't know if volatility is going to come out or expand, okay? And that's what we want to kind of isolate here. We're going to isolate the volatility. We're going to isolate the theta. And in that's why it can really be built in just about any environment or any implied volatility environment, whether it's high or low. But like I said, use this around the 50 IV percent because we don't know if it's going to go up or down. And there are better strategies out there for the other scenarios that we were talking about with really high implied volatility or really low implied volatility. I'm going to be specifically talking about this strategy in and around the mediums. That's when I usually go to this. Okay. All right. So this is going to be creating a synthetic short stock position for bear markets. Now, we've seen this market really come off lately, and some people are touting that we are entering bear market territory. All right. I don't know if that's true or not. If you watch the daily market commentaries, I think we've just come down to where the point of control is, and that's where the market's going to get comfortable for the next couple of weeks for the most part. It doesn't mean that there's not going to be other stocks out there. I'm talking about the broader markets in that last statement, but there are going to still be stocks that still stay in a bear market, and that's going to be perfect for this type of strategy because a lot of stocks are right around the mid-range for volatility. So it's almost a pick 'em right now. It's a great opportunity for this. What would you consider medium volatility or IV percent? Medium would be right around 50. So, somewhere with this strategy, I'm looking for the IV percent to be somewhere in the, 50s, 60s, maybe even the 40s, somewhere where it's right there in the middle of the range. Usually I like the sell options premium when it's above 70 or something like that, or buy it when it's below 30 is my extreme levels there for a stock, not necessarily an ETF, but for this one, particular one, a stock medium range IV would be right around 50. For a ETF, it's usually going to be lower than 30 is going to be around the medium range, okay? Because ETFs will spike up to like 100%, but those are going to be, outliers that brings that IV percent where it's a median range where you look at it and you see, okay, that's right in the middle of where it usually is, which should surely be somewhere below 30 for an ETF. Okay. That answer your question, guys? I see a couple of questions asking what I think a medium volatility would be. All right. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money I had earned, and I was trying to become a psychologist. But then I realized I really enjoyed the trading aspect of it or investing and switched my degree over to finance. After graduating college with a finance degree, moved to Chicago, and started trading on the floor of the Board of Trade there. One thing I really have to get over real quick is this disclaimer, and it says any opinions, news, research, or analysis or other information contained in this webinar or material provided by Pro Trader Strategies and associated companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. All right. I'm going to be talking about stocks that I may very well have in my portfolio. Okay. I'm not trying to get you guys to lemming off the cliff with me. I'm not trying to get you to do the same trade as me. I'm trying to teach you different ways to implement option strategies into your portfolio. If you've looked at a portfolio, especially recently in the last couple of months, like people have been calling me out of the blue, that their portfolio is getting crushed. It's generally because most portfolios are all long stocks, right? Well, this is a perfect example of why we should not have, 100% longs in our portfolio. We can take advantage of market corrections all the time. Even in a bull market, there are stocks that go down, and this is the scenario where we would want to implement something into our portfolio to take advantage of a down move. All right. One thing to remember is past performance of any trading system or methodology is not necessarily indicative of future results. All right. You guys can follow me on Twitter at Wolfman's blog. I do tweet out all of my earnings trades as long as I remember. I try to remember to do them immediately. I usually do them at the end of the day. So I tweeted out like NVIDIA today that I was trading that one. And the reason why I tweet those out, you guys, late in the day, I do daily market commentaries in the morning where I talk about the economic data that comes out, how that's going to affect the overall markets. And then I go into the way I see the markets, how I feel they're going to, the directionality that they're going to go, my market assumptions. And then I go into the trades that I put on or taken off. Okay. So I talk about every single trade, whether it's a winner or a loser in there. But later on in the day is usually when I implement my earnings trades. So I tweet those out for you guys, so you guys have access to those. And for instance, like NVIDIA, I tweeted out today, I sold calls in there. Yes, it doesn't tell you exactly my strike location, but if you know or watch my earnings webinars, you know exactly what strike location I'm looking for. And it's right around that 16 delta. Today with NVIDIA, I went a little further out to the 14 delta. All right. So synthetic short stock. What is synthetic short stock? Okay. I get this question all the time because of the synthetic aspect of it. The synthetic is just kind of like a fugazi or, a fake diamond or something like that. It looks, acts, and performs exactly like the real thing. All right. But we're using options. So we're building a stock position using options, which is that synthetic short stock position. So if you sold short 100 stock, we're going to be able to build that same short stock position with the use of just options. Okay. And it will perform just the same. And I'll show you how that all works out here in a little bit. But a couple of things to go over. Let's go through the synthetic short stock positions. Great for overbought stocks. That's the contrarian in me, okay? No audio. Anybody else lose audio? If you lose audio, try logging back on and logging back in. All right. If you ever have that problem, sometimes if you log off and log back on again, it will put it in there. So I thought let me send that. All right. For anybody that ever has that issue. So I'm a contrarian. So I love it when stocks get overbought and, just too much upside. Bear market conditions is also another good one, but I like the overbought mostly. But as you guys see in my daily market commentaries, usually I am early and I'm a contrarian. But if you have a bearish market assumption in something, which means it could be in a bear market or a bear market assumption, we can do either one of those. Anytime you have the feeling that the market is going to go down in something, you can use this strategy. All right. Pairs trade. For instance, if you were, I've done this actually not too long ago with Deere and Caterpillar, where I bought Deere and I shorted Caterpillar. They were basically, Deere was underperforming Caterpillar, and I thought that they were either Caterpillar was going to correct back down to about where Deere was, or Deere was going to catch up to it. Okay. So in a pairs trade like that, where you see something in the same sector that one has outpaced the other, and the other one's kind of lagging a little bit, like in this deer trade. Well, they're pretty much in the same space. Deer a little bit more towards farming, and Caterpillar more towards major construction or timber and stuff like that. But believe me, deer is involved in those just as well. All right. So they do have, it's not like Coke, Coke and Pepsi would be another one where people say, that's a good pairs trade, but it's not necessarily true because Pepsi owns the snack aisle. So if you're buying chips, you're actually buying Pepsi, believe it or not. So they're not always exactly the same, even though you would believe they are. All right. And hedging, if you wanted to hedge a position, you could easily do this for your portfolio, and hedging, an overly long portfolio. All right. Portfolio delta adjustment. That's what I'm talking about. When you're overly long and you start seeing the market correct, this is a great time to start throwing that in there. Okay, James, you're back. You got it? Did you just log back in and log off and log back in? Overbought, what are you talking? Are you talking about an indicator? No, Trevor, I'll show you a couple of examples that I look at when you see them getting overdone to the upside. It's usually when it kind of peels outside of my value areas on my charts for the market profile. All right. So portfolio adjustment, all of those things are great with this strategy. Some of the benefits also, you have the same risk as a short stock position. If you went out there and borrowed a stock, paid the maintenance on it, and all of those other things, this will perform exactly the same as a short stock position. And I'll show you when we build this out on the platform in the Analyze tab. We'll see it. This is going to use much less buying power, upwards of 50% less buying power than it would be for a synthetic short stock position. Usually in a short stock position, they make you come up with 50% of the value of that underlying. So $100 stock, you'd have to put up $50 for every one lot you did. This is going to use $25, all right, for that $100 stock. So 50% less than what you would have to put up for a short stock position. All right, and increasing your return on capital. I've talked about this numerous times. The beauty in options is your return on capital is much greater because when you use less buying power and it performs the same way as the other that we're comparing it to, then our return on capital is much better, right? We used less capital but got the same return, right? You also avoid having to borrow or the maintenance fees that come along with shorting a stock, okay? Anytime you short a stock, you're going to have to pay a maintenance to whoever you borrowed it from. You're also, one thing I forgot to mention here, you're going to have to pay the dividend to those people, all right? Building a synthetic short stock position, pretty simple. I mean, if you go online, this is exactly what they're going to say. They're going to say, sell an at-the-money call and buy an at-the-money put. One thing they're not going to tell you is to try to build this so that your deltas totally add up to 100. Sometimes we'll even be able to get over 100. Sometimes you're going to get less than 100. Just know that if you're getting less than 100 of the stock, keep that in mind that, hey, you're also, putting up half of what you would have otherwise, okay? So that 1 penny is not going to hurt you to the tune of what you're going to have to put up as maintenance for the short stock position, okay? So we're going to try and build it out to at least get 100 deltas. And I see a couple of questions. What do you mean portfolio adjustment? For a portfolio adjustment, if you are overly long deltas, and which most people are because, the advisors go out there and they buy you stocks, right? Well, then you're beholden to an upward trending market, right? If you want to take advantage of downside, then that's probably not going to be in your Edward Jones account, okay? Or your Charles Schwab account. They're going to mostly, or maybe a Charles Schwab, but Merrill Lynch and those, they're probably not going to be throwing you into a lot of short positions. So that would be the portfolio adjustment. the other thing is if you had a, maybe you have a portfolio of stocks in there and you wanted to add some pairs trades, all of those things are different types of portfolio adjustments. Does that answer your question? Can this be done in an IRA? It doesn't sound like it. In an IRA, it's going to be tough, but Nancy, I will show you some ways to get around those rules. Just remind me when I pull up the trading platform one more time so I don't forget that, because I want to make sure that I cover that for some of the people that are looking for it. I know some tricks of the trade to get around those rules. It's not necessarily going to help you on the margin as much in an IRA, though, as I touted a minute ago. That's more along the lines of the margin account. Okay. Okay, good. All right. And but remind me, please, to go over that again. And picking the right, sorry, I skipped over picking the right underlying. Picking the right underlying. Anytime, now, my rule for this is on a stock that's under $100, we're going to be looking for something that has the bid offer in the option montage tighter than 10 cents wide from the bid to the offer. And we're going to go to the monthlies that have, this is considered a monthly. It only has 1 day to go, but what we used to call it is the spot month. It's where the most time or where the most volume's been traded or being traded. And that's going to be those ones that are around the 30 some odd days to expiration. That's usually where people start going into it. So that's what we're going to be looking for this rule, picking the right underlying. Any stock under $100, green light is 10 cents or smaller, 10 cents or tighter. That's a green light. If you have been trading options for a long time or a specific underlying that you know very well and know the option pricing pretty well, then you can go a little bit wider. Just call that a yellow light. If you get too many yellow lights, you just don't do this strategy with that, okay? But one of the big reasons for this is you don't want to have to give up a lot of edge to get in, because if you have to give up a lot of edge to get in, you're going to have to give up more edge to get out, okay? And all of that eats into your profitability. Whereas when you have tight bid-ask markets, there's a lot of people vying to be the best market because they want in or they want out. So they're fighting over each other to better the market. And some of the ones where they're really wide, there may be only one dude in there and he's not even really completely paying attention to it. So you're going to have to go to his market and give up all that edge. And again, when you get out, you're going to have to come to him. And a lot of that will eat into our profit. So a stock under $100, if we want to trade it for the right underlying stock under $100 inside a 10 cents wide to the bid offer on the options that are closest to expiration, the monthlies. Now, if we're looking at something that's over $100, say $1,000 stock, then we just move the decimal 3 ticks to the left, and this one should be about $1.90 wide for the ones that are at the money on the monthlies. So somewhere closer to $1.90. That's not fitting this rule here for booking.com. Ever since they switched from booking or from Priceline to booking, their pricing has gotten really bad. But you could look at something like IWM is obviously going to have really tight markets because it's probably got the most volume and open interest. But you can see over $100 stock that fits that rule. We could look at something like CVX is probably going to fit that rule. After the market closes, sometimes it doesn't. They'll get a little bit wider, but this one fits that rule. Move it should be at least 11 cents wide, and we are making that rule work, okay? So just kind of go through it, and MasterCard should be at least 20 cents wide, okay? So you can see that's 15 cents wide. That fits that rule, okay? So that's picking the right underlying. Do you guys understand how I'm doing that there? How do you create your watch list? I actually have a video on that, Trevor, and I know you are a subscriber to my all my stuff. So look for that one. It's pretty easy. It's basically this gearbox right here on the customize. And for all of our premium members, I give out the script for the implied volatility % to throw over here. They don't give that to you with toss anyway. So that's picking the right underlying. Stock over $100 moves a decimal 3 ticks to the left. That's how wide the bid offer should be. On a stock under $100, 10 cents or less is what we're looking for there, okay? Oh, Nancy, you can get it from Toss. Yeah, you might be able to. All right, so picking the right strikes. Now, obviously, we said we're picking the at the moneys. That's pretty easy. This really goes to the point of trying to make this delta neutral, all right? You can trade this through earnings, okay? That's not a problem. It's not going to affect you. The volatility isn't going to affect you. And I'm going to go over several different things we talked about here real quick on this. But right now, picking the right strikes, the at the money. We want to go to the closest to at the money. And for this one, it's basically the 200 strike is the closest to at the money. Now, picking the right strikes, we want to try and make this 100 deltas. Now, this is a positive delta and this is a negative delta, right? So when we do math, we say we are going to sell this strike, right? We're selling these calls, which means we sell a positive negative, which makes these negative, right? We're selling these calls and we're buying a negative delta here. So we're buying more negative deltas. We sold this to make it negative. So negative 54 plus negative 46 makes us negative 100 deltas. That would be the same as selling 100 of the underlying short. And it will perform that way. So we can look here. I'll skip ahead real quick. So we're selling these and then buying the 200s like this. And then I will show you on the Analyze tab real quick how this looks. Let's analyze this trade. And you can see the purple line is the particular underlying we're trading, and the blue line is what we are doing. And as you can see with this particular trade, it runs in tandem with it throughout. If you watched last week's webinar, we saw a couple of them with the longs where the purple line kind of peeled up and went below and went up and then above it again a couple of times. This is a better example where you can see it runs in tandem with it. Notice the blue line, though, is above where the purple line is. The reason why is because we've synthetically created a short stock position, but in doing that, we actually sold MasterCard above where it's currently trading. Right? We got a $1.20 credit at the 200 strikes. So we add that credit in. Our break even is at 201.30. The underlying is trading right now at, I got to get my glasses out because I can't see it, 270. All right? So we're getting this 60 cents above where it's currently trading. That's another perk that I didn't have on the benefits of using a synthetic short position, is that we can actually sell this at the time at a better location than we could have otherwise done in the open market. That's the beauty of it. Sometimes it will also, and that's obviously a green light. If you can sell it where it's trading or above where it's trading, that is a full-on green light. It's a yellow light if you're selling it and you have to make up ground to get to your break even, okay? That's not going to usually deter me, but just know that you have too many yellow and red lights in here, then you know you probably should be moving on to something else that has a better fit, okay? Does that make sense? All right. So this is a good example of being able to do a synthetic short with a lot of things in our favor. All right, so that's picking the right strikes. The right duration, I talked about this. We could do this basically in just about any monthly expiration cycle, okay? We could, like I just built this one out in the December, which is, you know, closest to expiration. But if we're getting into this strategy, the beauty in it is we can go further out in time and it's not going to change a whole lot. So for instance, this one's 54 deltas, 64 or 46 deltas. That adds up to 100 negative deltas, right? Selling 54 deltas and buying 46 deltas gets us total short 100 deltas. But as you can see, that $1.35, I'm actually getting a little bit better. I sold it even a little bit higher the further out I go. It's not costing me anymore. You get way out here. We can look at it. Your margin's going to go up slightly when you jump out over those 100 days. But we can look at, for instance, if we just did this, created this trade, our buying power effect is 4,800. And then when I go out to the April, it may very well increase just a little bit. So you can see I've gotten even a better credit. So it's better to go further out in times, or at least check it. It's not always going to do just that. We have a situation here more times than not that it will get better the further out in time you go. I got it another $1 higher for this strategy. But you'll see, I believe we're going to probably have, maybe $800 more in margin, I'm guessing. So it's actually quite a bit more. It's went from 2,800 to an extra 2,500. So that one jumped on that one. It's not always going to jump that much, but I got an extra $1 in credit for my break even. That's going to have to be something you guys weigh your balance. Is it worth eating up that much more margin for an extra $1 plus $1.30 in break even? For me, it might. I might go out there to get that higher break even and pay and have the extra margin. But it also depends on your margin limitations as well. Okay. Selling at the money call and buying the at the money put, if it gives a credit, what is the risk? It's all the same. If it's a debit or a credit, your risk is going to be exactly the same, Banu. The bottom line is, because we built this out with 100 deltas, for every $1 move down this underlying goes down, we're going to move lockstep down for that $1 move. Now, the debit or the credit really is a product of whether or not, if I were to sell this one and then to buy this one, I'm going to come up with a credit. If I'm going to sell the one that's just out of the money and the one that's in the money, that's going to end up being a debit. But you can see if I subtracted $7.13 from the $210, that's going to put me right around the same location as the ones that I did for a credit. I usually like to get a credit, but that's just my my little quirk about me, is I always like to try and get a credit. And usually the ones that are closest to the money are going to give you that credit. Okay. So I would probably go with these anyway. Get that little bit of credit. It's all about the same. Very close. Did that answer your question? James, I like this approach a lot. Thanks for sharing. So how do we cover the naked call when we put on this trade in an IRA? Good point. All right. So an IRA only says you can't have a naked call in your IRA, right? But one thing they don't say, well, let me leave it as a 10 right now. They don't say where you got to define that risk, right? So usually what I do is go out, and with these getting a little bit wide, I try and go out and buy the first option I can for a nickel. And these are probably going to have a little bit better markets up here, closer. Let's look at this example. So I would go like this, and then, I'm getting a $1.35 credit, sold the calls, bought the puts, got 100 deltas short. So it's going to perform exactly the way the underlying does. And then I go out here and go, okay, where can I buy something for a nickel? It looks like this is going to be the strike I can buy for a nickel. And then I just buy that one. Okay, so I defined the risk to the upside. It makes it IRA appropriate. I'm still above the break even. You take this $1.30 credit onto the 200, right? I'm still above. That means my break even is at 101.30. I'm still above where this is currently trading. So that's good. It didn't hurt me. And that makes it IRA appropriate. just go out, buy the first call for a nickel that defines the risk, that meets the rules that these goofballs came up with for an IRA, and we can implement this there. Now, don't ever, this is a trade, you guys. This is not an investment kind of thing, right? This is a trade. So don't ever take it to that defined risk. Don't ever have that give you solace in knowing that, oh my God, if it gets up there, at least I'm out. I think I would come to your house and yell at you if you ever did that. All right. So be out well before that. As a matter of fact, I would say, you know, the 16 delta is where I would be thinking to get out on the upside, or the 16 delta coming this way would be where I would be getting out on a loss. Most likely, worst case scenario, that would be where I would ultimately pull the ripcord no matter what. So don't ever let it get to that defined aspect if that's what you're looking at. Right? So picking the right environment. Now, the right environment is that what I was talking about. Go with that 50 right around somewhere, you know, 60s, 50s, and maybe even into the 40s, because that is the gray area on most of my other strategies. Because most of my other strategies, we're talking about, we want extremes, all right, for selling and buying. This is the one where we want to go right in the middle, because I wouldn't want to sell options premiums around 50. They can go up, they can go down. All this is saying is that the implied volatility is mid-range of where it's kind of been in the past, all right? It's right around that 50 area. So you don't ever know if it's going to go up or down from there, all right? One thing I forgot to mention, implied volatility percent is what I'm talking about when I'm talking about the picking the right environment, all right? I'm not talking about the VIX. I'm not talking about the volatility for the broader complex. Every individual stock has its own volatility coefficient. All right. For instance, this one is looking like it's right around 29. All right. For MasterCard. Now, MasterCard's 29 is going to be low compared to, say, NVIDIA. All right. NVIDIA or Tesla. You know, some of those tech stocks are going to have much higher, and they may never get down to 30. That may be their extreme low implied volatility percent, right? So every stock has its own. So we need to figure out where the current implied volatility is now in relation to where it's been in the past, because they all have a tendency to have their extreme highs and lows, right? You know, we've been feeling a lot higher volatility in the last couple of months than we have for the last year or so. So we have to acknowledge that as being maybe the newer high extreme, right? Because we could see that last year, this implied volatility right now could have been at the highest level, but we are experiencing high implied volatility right now. Bottom line is, the way to come up with implied volatility percent is as simple as you take the sum in the numerator and divide it by the sum in the denominator. And in the numerator, we take the current implied volatility, this 29, minus the low of 16. So in the numerator, we have 13. And then we take the high minus the low, which is 40 minus 16 gives, or 40 minus 16 gives us 24, right? So 13 minus 24 gives us just slightly higher than 50%, right? Because 13 divided by 26 would be 50%. So we know it's a little bit higher than that. And this tells us it's 54. So that math is pretty easy. So if you don't have this over on your watch list or have it on your platform, then that's the way to figure it out. Another way to find it in TOS is to just look on the option montage page, the option montage page, and look for it right here. This is going to round it. This gives you the full decimals. That's the only real difference there, right? So that's picking the right environment. We want mid-range for this because, like I said, this can be done in any environment. It can be done with a high implied volatility. It can be done just as easily with low implied volatility. But there's higher probability strategies out there for those type of environments, okay? Realistically, the probability of success with this strategy is 50-50. It's the same as buying or selling a stock. Sorry, it was 15 minutes late. Is this strategy used when we sense a downturn? Yes. You sense a downturn, you sense a bear market, you think it's overbought, all of those types of scenarios. Any type of downward market assumption, mid-range volatility though. You know, downward market assumption with really high implied volatility, I'd rather sell calls against it. All right, know your exit strategy before entering the trade. Now, this is hard for me to tell you guys with this strategy exactly where to get in and where to get out, okay? I have my rules of where I get in and get out. I usually look at things for going to extremes, and I have that on my chart, you know, like where overbought would be where it gets above these little lines, and oversold would be above or below these lines. So that's usually where I start to look at things being overbought and oversold, is when they land outside of this, okay? Right here at the point of control, things are not overbought or oversold. They are right where we would expect them, okay? That's where the most time and volume has been spent. But once it gets overdone to one extreme or the other, that's where I like to take advantage of it usually, okay? When I like to do it with the over extreme levels. The other thing, I mean, if you guys wanted to, you could do it with your Fibonacci, where you threw up Fibonacci's. I think I got that on a, yeah. Oh, it's an extension. Let me just do regular Fibonacci's. Where? Regular Fibonacci. So, you know, if you trade with Fibonacci or Bollinger Bands, then stick with those, okay? Where your support and resistances are. You know, if it came up and tested this one, then that may be where you short, okay? You say, I get out, I'm getting in here, it's tested this, I think it's going to sell off. You know, if it touches this 50 Fibonacci, that's where I'm going to get out, okay? Stick with those same rules that have gotten you to where you are